Imagine me this. You're sitting on a beach on an island off Thailand, you're drinking an ice cold beverage, and the best thing about this is you're getting paid to do this. Why? Because you made the decision 2 years ago to start investing in dividend stocks, and you built up a massive portfolio. You own stocks like J&J, ExxonMobil, Chevron, Verizon, Coca-Cola, Disney, McDonald's, and JP Morgan to pay you dividends every month so that you can live this lifestyle. And guys, this is the number one reason why I like dividend stocks, because it gives you something called passive income. That's income that you get for not having to do any work. But the important thing when it comes to dividend investing is putting in the work up front. First, you have to make the decision to invest your money instead of spending it. Second, you have to invest it in strong, successful dividend stocks. And third, you've got to make sure that your portfolio is well balanced in different sectors, yields, and countries. In this video, we're going to go over the key things you need to know when building up a large dividend portfolio. And we'll finish off with some solid dividend stock picks from me as well. The very first thing you should ask is, why should I even start building up a dividend portfolio? Why dividend stocks? There are 4 key reasons. I've already told you the first one: passive income, getting paid dividends from companies for not having to do any active work. Second is, if you invest in dividend aristocrat stocks, they actually beat the stock market. As you can see from this graph, since 1990, dividend aristocrats have achieved a 12.1% return compared to the market's 9.8% return. Also, they've done this at less risk, less volatility, 14.2% compared to 17.4%. But arguably the most important and relevant reason why you want to invest in dividend aristocrat stocks is they tend to do way better than most in stock market crashes. You all know that we've had an 11-year bull market. There is a chance that the market may crash. And if it does, your dividend aristocrat stocks will perform better than most. They'll still go down, but just by not as much. As you can see through history, 1990, they beat the market by 8.8%. And that crash, the dot-com bubble recession, it was 19.2%, 22.7%, and 12.2% respectively. And in the housing bubble crash, dividend aristocrats beat the market by 15.1%. The next logical question that you should ask once you realize that dividend stocks are a quality investment is, where do I start? How do I choose good quality dividend stocks? The very first thing you need to look at is the dividend yield. I'm guessing that most of you will know what dividend yield is, but basically it's just the annual dividend divided by the stock's price. So let's just look at Coca-Cola stock, which is owned by Warren Buffett. Its dividend yield is 2.7%. That means the annual dividend is 2.7% of the price you pay for the stock. And a good rule of thumb when you buy a dividend stock is you really want it at least above that 1% yield. The other important thing to look at is the payout ratio, because where do dividends get paid out from? Well, earnings, of course. Generally, you want the business to not be paying out all of their earnings as dividends, or else what money will they use to grow their business? So, again, generally speaking, the lower the payout ratio, the better. Now, the next thing that we need to question is, how reliable is the stock's dividend that they pay out? In order to do this, I like to look at the dividend history of the stock. So let's look at Coca-Cola stock again. And there's a site called Macro Trends, which gives you a really good insight into the history of the dividend. So, as you can see with Coca-Cola, they've increased their dividend payout for 56 years in a row. Even when recessions have occurred, Coca-Cola have still managed to pay their dividend. Generally speaking, this means their dividend is reliable, and if the market were to crash, you would still receive that form of income. And the last key thing that you really want to look at when it comes to dividend stocks is how will the company do in the future? Will their earnings grow or decrease? Do they have a good business model? Do they have an advantage over their competitors? So, if you think about Coca-Cola, do they have a good business model? Yes, of course. Their customers absolutely love their product and it's drunk all around the world. Everyone knows about Coca-Cola, and that's one of their key advantages over other soft drinks. That's one of the reasons why Buffett bought Coke back in the day, because he knew about the customer loyalty and dedication to their product. So first, if you want to ensure that your portfolio does well, you need to pick good stocks that meet the requirements that we just talked about. But you also need to make sure that your portfolio is well balanced. So I'm just showing you what a well-balanced portfolio could look like when it comes to the different sectors in the economy. Obviously, this all depends on your particular interests and understanding. If you understand real estate more, you're probably going to have a high percentage in real estate. If you understand technology better, you're obviously going to own more technology stocks. I do like to have a decent amount in technology because I know how powerful this sector is. But it depends on who you are. Warren Buffett likes to own a lot of financial companies like the big banks because he understands them. He also owns a lot of consumer staple stocks like Coca-Cola and See's Candy because he understands how the businesses work and the consumer side of things as well. Anyway, the key point that I wanted to make was that you need to diversify your risk across sectors so that if one sector goes down, you are balanced in another sector. The other thing I would recommend diversifying across is countries. You could have all your wealth in the United States like Buffett pretty much has, but I personally like to own stocks in a range of countries. This way, if one country does bad for a couple of years, I'm not worried because my risk is spread throughout the world. My net worth is relatively safe. So it really depends on where you're from and what you know. But as I say, Warren Buffett likes to have pretty much all of his portfolio in the US and having reliable dividend companies there. But I also recommend, like Charlie Munger, having some portion of your portfolio in China, a country that is growing at a very fast rate in terms of economic GDP. Most likely, those dividends will keep growing as well. Then you also want to be diversified in the emerging markets, those countries that are building, developing, and getting lifted out from the poor class into the middle class, and making high returns as well along with that. Then Europe, a good place to diversify your dividend stocks into as well. And Australasia, first world countries that are less known, aka resulting in cheaper prices and higher dividend yields. But this is by no means a model portfolio. It just gives you some sort of idea and get you thinking on how you can diversify your dividend stocks across the world. But now to get you all started, I wanted to show you some quality dividend stocks that you could potentially use to start bulking up that dividend side of your portfolio. We've already mentioned the stock Coca-Cola. It's the stock that Warren Buffett has owned for years and it pays a handy dividend. As you can see, it's a 2.7% yield with a market cap of $250 billion. And they own a bunch of big brands as well. They don't just own the drink Coke. You've got Fanta, Sprite, Schweppes, Simply Orange, and a bunch of other billion-dollar brands. So they are well diversified from the start. Another dividend stock to own, which is also owned by Warren Buffett, is Wells Fargo. Very nice dividend yield in today's market of 4.3%, and it will provide you good exposure to the financial sector and the USA economy. AT&T is another stock that pays a really nice dividend yield, 5.4%. This will give you exposure to the telecommunication sector and 5G as well, an up-and-coming industry. A more global dividend stock that you may want to consider owning is BP. They're in Europe, North and South America, Australasia, Asia, and Africa as well. And they're obviously the fuel company that we all know, but they're also engaged in other businesses like selling everyday items such as paints, clothes, and packaging. Their dividend yield is really nice at 7%. So when building a dividend portfolio, I recommend starting off with first businesses that you understand. So whether that be Coca-Cola, the beverage business, BP, which is fuel, AT&T, telecommunications, or something like Disney, which is entertainment. Whatever passion you have, start there when it comes to building up your portfolio. And then what you want to do is build and grow upon your circle of competence and start investing in perhaps more complex businesses that have higher dividend yields. Another thing that I recommend is following what stock experts are buying. For example, in this video, I showed you a lot of Warren Buffett stocks, or you can see what the likes of Ray Dalio or some other expert is buying. As I've told you guys before, my go-to guy is Fen Carlin, who actually beats most of these investors that I've just mentioned because he does not have to invest billions and billions of dollars like them. He can focus down more where there are opportunities in smaller companies. So I'll leave a link on where you can see his stock buys in the description below. So, in order to build up a large dividend stock portfolio, start with the basics. First, instead of wasting your money, invest it. Pretty simple principle. But invest this money in companies that you understand with strong dividend yields, low payout ratios, a strong dividend history, strong business models, and of course, a bargain price. Do these things along with being well balanced in your portfolio, and you will be successful.